Tesla's meteoric rise has captured global attention, but what's really behind the soaring stock price? With net income dropping sharply from $7.9 billion to $1.1 billion, and debts climbing past $12 billion, we're diving deep to assess whether Tesla's growth is truly sustainable. Ready to explore? Let's go! Tesla specializes in designing and manufacturing electric vehicles and energy storage systems. Its innovative technology and vertical integration strategy, controlling multiple production stages, aim to enhance efficiency and reduce costs. However, significant capital expenditures and reliance on a limited product line present potential risks for investors. Examining Tesla's latest balance sheet, the company demonstrates strong financial vitality. Cash and equivalents have surged to $18.1 billion, reflecting robust operational cash flows and effective cash management. Conversely, total debt has increased to $12.7 billion due to significant capital expenditures exceeding $11 billion, funded partly through new debt issuances. The debt-to-equity ratio remains stable at approximately 0.18, indicating prudent debt management compared to industry norms. Retained earnings have grown to $32.6 billion, showcasing consistent profitability and reinvestment into operations. While these strategic investments position Tesla for future growth, the elevated debt levels could pose risks, especially if interest rates continue to rise. For value investors, the key takeaway is Tesla's ability to balance growth with financial stability, although monitoring debt levels remains essential. Here's a screenshot of the full balance sheet. Notice the increase in inventory and prepaid expenses, which could signal upcoming production scaling. However, the growth in deferred revenue suggests Tesla is booking future deliveries, which might impact cash flow management if not balanced effectively. Understanding these dynamics is crucial. Tesla's recent income statement reveals important trends. In Q3 2024, the gross margin improved to 19.8%, indicating better cost control despite lower selling prices. This suggests Tesla is efficiently managing production costs. Net income margin rose to 8.6%, boosted by delivery efficiencies, with new models like the Cybertruck. This is a positive sign, as a higher net income margin means more profit from each dollar of sales. However, over 9 months, net income decreased due to temporary production issues. Investors should note potential risks like inflation and changing consumer demand, which could impact future profitability. Here's a screenshot of the full income statement. Notably, operating expenses have increased slightly, driven by higher research and development spending, which is a positive long-term investment in technology and innovation. However, keeping a balanced increase is crucial to avoid impacting profitability. Comparing Tesla's expenses and R&D investment with competitors ensures competitive positioning and potential for growth. Tesla's revenue shows resilience, peaking at $25.5 billion in Q2 2024, before a slight dip to $25.1 billion in Q3, reflecting strong demand for new models like the Cybertruck. However, net income tells a different story, dropping sharply from $7.9 billion in Q4 2023 to $1.1 billion in Q1 2024, then gradually recovering to $2.1 billion by Q3. This suggests margins are under pressure, possibly due to increased costs or pricing strategies. Investors should note that while revenue growth is encouraging, net income volatility may indicate underlying challenges. Comparing to industry peers, stable net margins are crucial for long-term value. Tesla's free cash flow surged to $2.7 billion by Q3 2024, reflecting efficiency gains and lower production costs. The free cash flow yield, a measure of cash generation relative to market value, is a robust 17.7%, indicating effective capital use. Capital expenditures have risen, emphasizing substantial investments in AI and factory expansion. This rise in CapEx margin underscores management's focus on tech integration and scaling. Stock-based compensation remains moderate at $457 million, balancing talent retention and shareholder interests. Although current cash flows are strong, future challenges from increased capital spending and market volatility could affect financial health. Here's a screenshot of the full cash flow statement. Notably, net cash from operating activities increased to $10.1 billion, underlining Tesla's strong operational efficiency. However, cash used in investing activities reached $11.2 billion, indicating significant reinvestment. This heavy investment could pose risks if returns don't meet expectations, a crucial aspect for value investors to consider. During Tesla's recent earnings call, several key points stood out. The company reported solid revenue growth, driven by increased vehicle deliveries. However, profit margins have tightened compared to previous quarters, partly due to price cuts aimed at boosting demand. This margin compression is a concern for value investors who prioritize strong profitability. Tesla's management also discussed significant investments in scaling up production and advancing autonomous driving technology. While these investments could fuel future growth, they also require substantial capital expenditure, affecting free cash flow in the short term. Additionally, competition in the electric vehicle market is intensifying, which could impact Tesla's market share and pricing power. Overall, while the company's growth prospects remain promising, the narrowing margins and high capital spending present potential risks that investors should carefully consider. Analyst estimates project Tesla's net income to reach $19.0 billion by 2028, with an expected earnings per share of $5.40. Earnings per share measures the company's profitability allocated to each share, a crucial indicator for investors. This optimistic outlook reflects Tesla's strategic focus on growth areas like artificial intelligence and renewable energy. However, inflation and increasing competition could affect vehicle affordability and dampen demand, introducing uncertainties to these forecasts. Management is tackling these challenges through cost reductions and operational improvements to maintain their competitive edge. Investors should evaluate whether these strategies effectively mitigate potential risks in light of Tesla's ambitious growth goals. Comparing key metrics, Tesla's price-to-earnings ratio of 52.5 and price-to-book ratio of 12.5 indicate a premium valuation compared to peers like General Motors and Li Auto. This suggests strong market confidence in Tesla's growth prospects, fueled by its commitment to innovation and cost-efficient production. However, high valuations set high expectations that Tesla must meet to justify its stock price. The competitive landscape is intense, with other electric vehicle manufacturers advancing rapidly. Continuous innovation and expansion of product offerings are crucial for Tesla to maintain market leadership. Investors should assess whether these valuations are sustainable, considering the competition and the company's ability to deliver on growth expectations. Our discounted cash flow analysis, which predicts future cash flows and adjusts them for present value, estimates Tesla's equity per share to range from $36.10 to $54.20 by 2028. This suggests that despite Tesla's strong focus on artificial intelligence and renewable energy enhancing its intrinsic value, the current market price might exceed realistic future earnings. The wide valuation range reflects uncertainties in economic conditions and competitive pressures that could impact cash flows. Investors should note that small changes in growth assumptions can significantly affect DCF valuations, underscoring the need for cautious consideration amid optimistic growth narratives. Analyst forecasts for Tesla's stock over the next 12 months vary widely, ranging from a low of $88 to a high of $515, with an average target of about $254. This broad spread reflects differing expectations on Tesla's ability to expand in artificial intelligence and energy storage markets. The optimistic high predicts significant growth from these ventures, while the cautious low accounts for potential impacts of macroeconomic shifts. Understanding this range helps investors gauge how strategic initiatives and external economic factors could influence Tesla's future valuation. Tesla's remarkable growth presents a compelling picture, yet beneath the surface lie challenges that cannot be ignored. The sharp decline in net income and mounting debts contrast with strong cash reserves and a stable debt-to-equity ratio. Improved margins amidst lower prices reflect operational efficiencies, but net income volatility and heavy capital expenditures introduce risk. While strategic investments in AI and expansion signal future potential, the high valuations hinge on Tesla meeting ambitious expectations. As value investors, we must critically assess whether Tesla can balance innovation with sustainable financial health.